Hey everybody, I hope everyone is doing well and had a good day. In this video, I will review the Emini 5-minute chart for Thursday, August 21st, 2025. And the first thing I want to talk about is really the higher time frame chart. Let's look at the daily chart for just a moment. This is the .D, the RTH. Here's the Globex chart. So we have less caps on this chart. And here's the information. Here's what we had going into the day. Now we had this sharp reversal attempt followed by a parabolic wedge, trend resumption, but at a new high. We found sellers, micro double top, and we're getting a bear breakout, a micro channel, and here we had a bear breakout and a follow-through bar. And this was actually really solid for the bears because the follow-through bar, even though it closed above its midpoint, went far below the low of the prior bar, which increased the distance of the breakout. So the trapped traders above, they're disappointed, and it's very likely that we'll get a second leg down. So there's probably sellers above yesterday's high. It's a bad stop order buy signal. But the tail on yesterday suggests that we're probably still in a trading range. If we look to the left, it looks like the market's in the middle of a trading range. And if we do get below yesterday's low, well, there's probably buyers below yesterday's low. So I'm expecting sellers above, buyers below, and trading range price action today as we're in the middle of a trading range. Gap down, always good to look at the Globex chart going into the day. I like to look at the 15-minute generally. And so back here, yesterday's close, here's the overnight session. We had a trading range and then a bear channel with several legs down, breakout attempt of the channel line, which appears to be failing. Every time we try to break below the channel line, we find support. We try to break below it again, probably going to find support. So this was actually, that was a little bit into the day. Here's what we had going into the day. So 3 legs down, reversal and follow through, probably buyers below. The problem with buying here is you're buying near the trend line, and it's still probably a minor reversal. But it's enough of a reversal for there to probably be buyers below, and this channel will probably evolve into a trading range. It's still a higher low. We look to the left, big down, big up within this bigger, more broad trading range. So for the 5-minute going into the day, we see the gap down. We know we might have a late leg down on the Globex chart. We're also testing the low of bar 59. So we're expecting support here. The last time the market was here, it rallied for many points. And now what the bulls are hoping for is a double bottom with bar 59 and bar 1. But bar 1's a bad stop order buy signal bar. Has a bear body. And it's enough, the gap down, you can think about it as a breakout. And this is probably going to get a second leg down before there's any major reversal. So because of that, the bulls, instead of looking to buy above bar 1, they'll probably look to buy a second reversal. If we think about what a second reversal is, it implies that there's a second leg down. For there to be a second reversal, there has to be a first reversal. The first reversal has to fail. Then there's a second attempt down, then a second reversal. Inside bar 2. 2 is an inside bar, so range compression, lower high, higher low. Triangle on a smaller time frame, breakout mode, probably sellers above and buyers below. And still the gap down will probably get a second leg. And then another inside bar on 3. So the range continuing to compress. The market's in breakout mode, so probably better to wait for the breakout. Breakout attempt on 4 pretty big bar, but the bar got bought all the way back up into the close. So at one point, bar 4 was a bear breakout bar on its low, but it reversed all the way back up. Now this might have been enough for there to be disappointed traders above and sellers above. If we think about bar 4, it's technically not a second reversal. It's an implied second reversal because we never triggered a buy above 1, 2, or 3. But it's an implied second reversal, 1, 2. But the problem with 4 is that it's a big bar and it's in the middle of a trading range. So the probability, probably 50-50 at best, and the big bar, so big risk, your risk reward, not very good. If you're going to take a trade with risk reward that's not very good, you need high probability. And if you're going to take a 50% trade with average probability, you need good risk reward. And you don't have that if you're buying above bar 4. So 4, probably sellers above, maybe even sell the close. And then the same with 5, probably sellers above. 4, even though it reversed all the way up, might need a second leg down. And that's in part due to the gap down needing a second leg, and 4 may not have been enough. Consecutive bear bars, 5 and 6. Now this is already a third attempt down. We tried to go down on 1, we paused, tried again on 4, reversed up, and we're trying a third time, 5 and 6. So there might be buyers below 4. When you're getting a third leg in a trading range, it's dangerous to be selling when you're approaching the lower third of the range. I don't have thirds here, but we can see the middle of the range is about here, and we're certainly in the lower half. 7, outside up, a little bit of a surprise bar. Again, 3 attempts down and then a big reversal. But bar 7, the problem with buying bar 7, forcing you to buy right below resistance, we're right below the moving average. It's a big bar, so big risk. And again, you're just about in the middle of a trading range. And with trading range price action, I prefer to enter on pullbacks and capture delayed second legs. So to me, 7 is not a buy the close bar. And this little rally we had was hard to trade because I'd prefer to look to buy a pullback. And to me, it's not really worth it. Even if you bought the close, you didn't get 1R. This is kind of a spike in channel on the smaller time frames. It's a minor pattern, but 7 through 12 is a spike in channel bull trend. But 12 is testing resistance. We're testing yesterday's close, and we have 3 pushes up. So we have a push up on 7 and 8, a pause on 9, another push on 10, inside bar, pause 11, and then outside up 12. So another situation where you have 3 pushes to resistance in a trading range. So 12, probably more of a sell the close bar, or a bar that traders will look to sell and maybe scale in higher rather than look to buy. For the bulls, technically the stop is below 7. No bull's going to buy here and put a stop below 7 and let that stop get run. But really the problem here for the bulls is the risk reward. Your stop is very far in theory, and it's kind of an unrealistic profit target, especially considering the momentum, small bars with overlap, and 3 pushes to resistance. So we may have to correct here for a couple of legs and maybe even reverse because, well, the market's in a trading range. And it might be an expanding triangle. Up and down on 1, down on 4, new high on 12. Maybe we fall to a new low. 13, a strong bear breakout bar, but heavily overlapping the prior bar. But 13 is still strong enough for a second leg down. Spiking channel at a minimum, we're probably going to test the low of bar 8. And then 13, 14, strong breakout and follow through for the bears. Is 14 sell the close? Probably not, because it's in the middle of the trading range, middle of the day's range. Risk is big, so stop above 12. If you sell the close 14, your stop is far. And And again, your probability is probably 50%. So rather than sell the close 14, what bears will do is sell a pullback, maybe the 50% pullback, maybe the moving average, breakout points, a low of 12, rather than selling in the middle of the range. But 13, 14, there's a high probability that bars 13 and 14 get a second leg down after a pullback. The bulls are hoping it's simply a 50% pullback of the rally and we get a new high. But the bears need a second piece, a second leg, before the bulls get their second leg. And it's not guaranteed that the bulls get a second leg because they had a spike in channel structure already. The bears don't have a completed structure here. So at a minimum, we're probably going to test the low close of 14 or the low of bar 15. 15 is a good looking bull bar, but not especially big. And after that much momentum, again, a second leg down is likely. So the first reversal is probably going to be minor. It's probably sellers above 15. 16, low one short. But sell the closed bears on 14, disappointed with 15. So there might be temporary support at the close of 14. And maybe 15 being a strong enough bar for a second leg. Maybe it gets a minor second leg. But is 16 the second leg for 13 and 14? Probably not. It's probably not enough. 17, the bulls getting a second leg. 1, pause. 2, this is setting up a low 2 short for the bears at the 50% pullback of the breakout and follow through. So 17, a second leg at resistance in a trading range, more of a sell the close bar. Not ideal for buying. Small follow through bar, but now testing the 50% pullback. And bears will sell this bar. They're seeing the bulls are getting 1, pause, 2, maybe a third push on 18 at the 50% pullback. Bears will sell, betting that will test the lows. And again, the bulls are hoping it's a big breakout, 50% pullback, and we rally to a new high. 19 sets up the implied low 2. Technically, it's a low 1. We did not fall below the low of a prior bar here. So the way I see it is 16 implied low 1, and then that makes 19 the implied low 2. So a second entry short, just about at the 50% pullback. Incomplete structure, so the bears need a second leg. The bulls have a two-legged pullback. So to me, 19 is a reasonable stop order sell. If you're long, reasonable to exit below 19, and stop order bears can sell below 19, at least for a scalp. And the entry bar for the bears creates a bad high 1 for the bulls. So we're at resistance. We have consecutive bear bars, reversal, and follow through. So probably sellers above 20, and might even be sell the close 20, betting that we'll at least get to the low of bar 15, as the bears will probably get a second leg. Realistically, this was a pretty strong breakout. They'll probably get a symmetrical second leg and get below the low of 15. That's what they got on 21. Now what's the problem with 21? We know the market is in a trading range. I want to try to think about this in a systematic way. How can we decide if the market is in a trend or in a trading range? One of the simplest ways is by using the moving average. Trending markets typically, in a bull trend, the bulls control most of the bars, if not all of the bars, above the moving average. Bear trend, it's the opposite. Bears control price below the EMA. In a trading range, you get bars above and bars below. You get big bars with bad follow through, breakout gaps close. And if we weigh all of that, and even just visually looking at the chart, we know the market is in a trading range. So we're not trending. It's not a bull trend. Well, I can put this two ways. It's a trading range, but there's always an argument that in a trading range, it's a bull trend and a bear trend. So we have lower highs, and maybe the bears here getting a channel and they'll get a lower low. But at this moment, the bulls have the argument that we're creating higher highs. So in a trading range, there's usually an argument that there's a bull trend and a bear trend, and it's not really clear who wins until there's a breakout. But at this instant, it's clear that the market is in a trading range. Again, if we just use the simple method of looking at the bars in relation to the moving average, we have bars below, bars above, below, above. It's relatively flat. So we know the market's in a trading range. And the reason that is significant, it's important to know, is because if the market is in a trading range, then breakouts are minor. There's no major trend direction here. So what happens is the bulls and bears take turns. I kind of think about it like the game Pong, and price bounces back and forth between support and resistance, and it usually takes 2 or 3-legged patterns to get there. So talking about a trading range, 2 legs is important because second leg traps are common. You get a breakout like 21, and it's easy to see a bar like 21 and panic and think, I'm going to get short. It's a really strong bear bar, and it's going to go for 1R. We're going to get to a new low of the day. I got to sell. But when we think about the fact that it's very likely the market is in a trading range, second leg traps are common in trading ranges. And what happens with a second leg trap is, well, first of all, if we're counting spike breaks for leg count, this is clearly leg 2. So leg 1, pull back, leg 2. Leg 2 often looks really strong, but it's testing support. So we're in the bottom third of the day's range. The purple line is the midpoint. So below the midpoint, we're in the lower half, close to the lower third. And 21's accelerating, but it might simply be a vacuum test of support. And what I'm trying to say here is that it's really important, if you're selling 21, first, it's probably better to wait for follow-through selling, for a follow-through bar. But even then, you need sustained follow-through. The only way you can justify selling in the bottom third of a trading range is if the bears are getting momentum. Otherwise, you might be selling a second leg trap, your stop is far, your risk-reward profile is bad, and your probability is bad, because in the lower third, the probability favors the bulls. So 21 might be a second leg trap. So if we think about breakouts and what's more likely here, would you rather sell the close 21, stop above, let's just say the bar, stop above 21, sell the close 21, your target's 1R, or would you rather buy the close 21, stop a measured move down, and target the high of the bar? To me, it makes more sense to fade the breakout because it's a second leg in a support zone in a trading range. So we got the reversal on 22. 22, a bad bar for the bears. It's a strong bull reversal bar. The bulls see a big high 2, so bull breakout, pull back, high 1, second leg down, reversing back up, and a high 2. The problem for the bulls is that the pullback was deep, deeper than 50%. Once it gets to about a third or 2/3 of the way down of the bull breakout, let's say it's from bar 7. So here's 50%. We pulled back deeper than 75%. This might be an 80% pullback. When that happens, the probability of getting to a new high or to a new low is about the same. So we're in a trading range. We have a second reversal up, 1, 2. Bears probably exit above 22 and bulls can buy, but the upside, we're not guaranteed to get to a new high here because this pullback was so deep and the selling pressure is so strong that the probability that we get back up here is reduced, and we may actually get to a new low before we get to a new high. As far as 22, probably buyers above at least for a scalp. And then 23, bull breakout bar. So reversal and follow through, a couple of strong bars for the bulls, good for the bulls, but now we're back at resistance. We're testing an area where the bulls got trapped. Remember bar 18, bull breakout and follow through, traders trapped on the close of 18 by 19, 20, 21, and we're retesting this price. This is also the low of 12, so 12 was a breakout point, low of 12. 12 is a bad stop order sell signal bar. It's a bull reversal bar closing on its high. But if you bought below 12, you got trapped on 13 and 14. So the low of 12 becomes resistance. And we saw that happen here on 18, 19. And the same thing likely happening on 23. Until the bulls break far above it, it's still probably resistance. And again, taking into consideration the depth of the pullback, the bulls are hoping it's a big high too, and we get to a new high. But the pullback was so deep and the selling pressure is so strong that the upside here might be limited, and we're back at resistance. So this is the sell zone of the trading range. And then a bad follow-through bar, no follow-through after 23. So 24, probably sellers above. 23, 22, 23 will probably get a second leg up, but it may be very small. And it may just be one bar, like 25. 25, a second push up, and it's nested. 1, 2, and here, 1, 2. So 25, kind of similar to 12 or 18, might be a better sell the close bar because it's a second push at resistance in a trading range. Bad follow-through bar. 25, remember I said if you're buying, I mentioned the opposite case, but if you're buying high in a trading range in the second push, your risk-reward profile is bad. Your probability, not very good. The only way you can justify buying here is if you have sustained momentum. Is 26 momentum? No, it's disappointment for the bulls. So the bulls will probably give up here. 26 might be a sell to close bar. 27, the bulls getting a third push. 1, pause, 2, pause, outside up, 3. Again, similar to 12. 3 pushes up to a sell zone, resistance in a trading range. So dangerous to be buying, risk reward, and probability favors the bears. Bear breakout 28 will probably get a second leg down. In this entire breakout, the two legs, 13, 14, and down to 21, is a breakout on a higher time frame, and you would not see the pullback, or the pullback might be very minor. In this entire move from the 12 high to the 22 low probably needs a second leg. And that's what's happening on 29. 29 is now a third attempt down. So 1, pullback, 2, pullback, 3. But it's not clear where the bottom of the range is. We don't have to stop at the low of 22. And if it is an expanding triangle, we can get a new low of the day. But as far as selling here, it's not ideal because you're now selling back near support. And the bulls have an argument that there's a trend line, but the bears breaking below the trend line. So we're now below the higher low 22, breaking below on 31, and this becomes resistance. So we pause and test it, trying to reverse, but 33, probably minor after this much selling. Even though it might be leg 3, this needs a second piece. 33 is unlikely to reverse in a major way. Reversal and follow through, but again testing resistance. Range expansion on 29, we paused on 30, expanded again on 31. So 30 is a trading range. Breakout, pause, breakout. We're testing the pause at 30 on 34. There's probably resistance here. Bad high 135, sellers above. You also have the moving average, which is probably going to act as resistance. And then 36, bears get a small second leg. We're in the bottom third of the trading range, not ideal for selling. That is all the time I have for today, unfortunately. But overall, we can see what happened. The downside was limited. We went to a new low, but did not get very far. And ultimately, the bears had a spike in channel. Lots of trading range price action here. We tried to break below it and failed. Strong reversal, 48, 49, 50, but that resulted in more trading range price action. Lots of sideways through here. You can see all the overlap in this area. Tight trading range and overlap like this, these are areas of agreement. So when the market tries to break out of trading ranges like this is an area of agreement. Lots of trading taking place, both sides scalping, and then when the market breaks out, there's an 80% chance, generally speaking, 80% chance, 80% of breakouts of trading ranges fail and reverse. So we broke below, we failed, tried to break below again, reversed up in a big way. But then we continued going sideways in the same general area. All right, that's going to be it for today's review. Thanks, everybody, for watching, and I hope everyone has a great night.